Anthony Parent here with IRSMedic. Today I have 6 possible ways I know of to avoid, or perhaps more accurately, mitigate GILTI tax exposure. Are you guilty? Let's find out. By this time, you probably know that GILTI stands for Global Intangible Low Tax Income. In previous videos, I explained the rough idea of what GILTI is, and in the next video of this series, I'll be discussing how to calculate GILTI liabilities. Now, after calculating those GILTI liabilities, you may now realize how important this topic is. So be sure to subscribe so you don't miss out on any important updates. So now let's get to those 6 ways. First, you can elect to convert GILTI to Subpart F income. Now, you might be scratching your head on this. If you understand a little bit about international taxation, you know that Subpart F is something to be avoided. However, GILTI can be so bad that it can make Subpart F seem good. The second way is a little bit more opaque. You can increase something called QBAI. QBAI stands for Qualified Business Asset Investments. There are a few ways to do this. For instance, you could purchase equipment that you were previously leasing. Now, the downside to this is just because someone is a shareholder in a controlled foreign corporation, it doesn't mean they can actually control the corporation enough in order to implement this strategy. Management might not be all that hip to this idea. And second, this is a business decision that could have a negative effect to your cash flow. You might solve a GILTI problem, but you could end up with a business problem. Third, GILTI is not calculated on a company basis. It is done on a shareholder basis. And what's worse is that losses in one CFC may not get full credit against gains of another CFC. The way to make sure you don't miss out on any of these losses is by combining CFCs. Fourth, simply avoid either having CFC status or U.S. shareholder status. The problem with this is that tax reform expanded the definition of what it means to have CFC status. However, by adjusting ownership levels with non-U.S. owners, you may be able to find a great solution that avoids this entire mess. The downside is this is not feasible for many people. Second, you need to watch those attribution rules, which also change for the worse. When you have related parties, you might be considered to have CFC, even though you would not otherwise if the parties were not related. The fifth way, and this is proving to be the winner for many of our clients, is to funnel all shares of foreign corporations into a domestic U.S. holding company. You know, this was an overriding theme of the 2017 Tax Cuts and Jobs Act, bring back capital to the U.S. The reason why this strategy works is that U.S. C corporations are allowed to do something U.S. individuals are not. Take what is known as a Section 250 deduction of 50% of GILTI. The downsides are that this does require extra hurdles of having a U.S. domestic corporation, which you must honor those corporate formalities of, and additional tax filing requirements of the domestic corporation. However, if your GILTI liabilities are even as low as, say, $20,000 or even $10,000, it could still be worth the hassle to create this structure. A sixth way I can think of is this. What about putting shares of a CFC into a private placement life insurance policy, or PPLI? PPLIs are used by the most sophisticated investors for what I consider to be the ultimate tax structure. Essentially, how it works is that your assets go into a life insurance policy and you borrow from the death benefit while you're alive. And because death benefits are tax-free, you essentially avoided all income taxes, both federal and state. This is an even better move to make if you happen to be in a high-tax jurisdiction like New York or California. The downside is that life insurance turns most people off, and these are complicated structures that require a flexibility that many business owners are unwilling to exercise. Additionally, the costs are intense. Typically, it only starts making sense when you have about $10 million in assets. Now, we're working on ways to reduce the cost, and I'd love to hear from anyone who has been able to implement a PPLI for someone with less in assets. But also, I have yet to hear of a PPLI that has been implemented strictly with CFC stock. Now, there are also diversity requirements of a PPLI's portfolio that could force you to sell your stock, so much so that you might not even have a CFC anymore or U.S. shareholder status. Also, you must be very, very committed to following the structure. People get into troubles with PPLIs when they don't take the rules seriously. Are there other ways you can think of to eliminate or mitigate GILTI? I'd love to hear about them. Please leave them in the comments below. If you or your client needs help with a GILTI issue or any other international tax issue, please feel free to contact us. Now, if you think you'd be a great guest for our channel, please email us at info@irsmedic.com. Like and share this video if you deem it to be worthy. This is Anthony Parent of Parent & Parent LLP, IRSMedic. Thank you for watching.